Okay, let's have a little look at interest rate swaps. Now, if you remember, an interest rate swap occurs where we have two companies who both want to borrow the same amount of money, typically one of them with a better credit rating than the other, and they work together to try and make sure that they save money on their borrowings. Now, that would normally be quite a difficult thing to do, to find another company that matches that profile. So don't forget, in the real world, banks will normally charge companies and actually be the ones that put them together for this swap process. The bank will normally make a bit of extra cash from this by charging the companies. But the examples you're going to see in the exam, you're not going to have to worry about bank charges or anything like that. So the scenario you've got here is pretty much what you would see in an exam situation. So we've got company A, who can borrow fixed at 10% and variable at SONIA plus 1%. Now SONIA is just kind of the interest rate that banks lend to each other at. So think of that as being base rate is possibly the closest that we can get as an analogy. So essentially you can borrow variably at base rate plus 1%. But we're just calling that SONIA, as you do. Do remember that in some of the older questions and examples that you'll see, SONIA used to be called LIBOR, but it's the same principle, it's just an expression of base rate. A wishes to borrow fixed. The other company, B, has a better credit rating than A, so it can borrow more cheaply, you'll notice. It can borrow fixed at 9% and variable at SONIA or base rate plus 0.5%. It wants to borrow variable. Now, it doesn't mention how much these two companies want to borrow, so we're going to assume it's the same amount. The amount doesn't really matter for these questions. All that really matters is it's the same amount these two companies wish to borrow. And you'll notice, and again, this is standard in all these examples, A wants to borrow fixed, so one company wants to borrow fixed, and one wants to borrow variable. Construct a swap that will share savings evenly between the two companies. Now again, most scenarios ask you to share any savings evenly. If it doesn't specify, just assume that you're sharing any gains or savings evenly. Some questions though will tell you that the gains need to be split out differently, not 50-50, in which case you'll need to make sure that you take account of that in the answer. So let's have a look at how you would construct a swap for A and B. Okay, now I've left the numbers up for you from the scenario at the top of the screen, so you'll be able to see hopefully where the numbers come from as we run through. Now, the thing to remember is A wants to borrow fixed and B wants to borrow variable. So one of them is going to have to borrow fixed and one of them is going to have to borrow variable. You need two loans to satisfy these two companies' needs. Okay, so what we need to do is decide who's going to borrow fixed and who's going to borrow variable. It won't necessarily be the rate that they want. Okay, so just bear with this for the moment. What we're going to do first of all is set the swap up. And we do that by identifying the type of loan that has the biggest rate difference between the two companies. So we know that one of them is going to have to take out a fixed loan. So let's have a look at who will make the biggest saving on a fixed loan. Well, A can borrow at 10%. And B can borrow at 9%. So that means that if B takes out the fixed rate loan for the companies that these two companies need, then that will give you an overall 1% saving compared to if A had taken out the fixed loan. The variable loan difference though is a little bit narrower. So A can borrow at SONIA plus 1%, B can borrow at SONIA plus 0.5%. So if B was to do the variable rate borrowing that these two companies need, you'd only make a saving of 0.5%. So fixed gives you the biggest overall saving between these two companies. Okay, there's a bigger difference between the two interest rates with fixed. So what that means is because B can borrow fixed the cheapest, and that's got the biggest saving, then B has to borrow the fixed rate loan that these two companies need. Now we need a fixed and a variable loan, so if B is borrowing fixed, then A has to borrow variable. Now you'll notice that that is the exact opposite of what these two companies want. that is very standard. You'll often find that they'll actually end up taking out the exact opposite type of loan to the one they originally wanted. But that's absolutely fine. It'll come out in the wash, as you will see a little bit later. So we now know B is going to borrow fixed, A is going to borrow variable. Now what we then need to do is to decide on the gain. So who is going to, what saving can we make, and who's going to make what saving in theory? Now like we said, this group, these two companies, you need to take out a fixed loan for one of them and a variable loan for the other. So there are two loans that have to be taken out. We've just decided that B is going to do the fixed borrowing. So B is going to take out a fixed rate loan. That will save 1% on interest rates compared to A doing it. A is going to have to borrow variably, okay, and take out the variable rate loan. However, like we saw before, A does have a worse credit rating than B. So because of that, A is actually going to pay 0.5% more than B would. So overall, that loses 0.5% in this kind of swapping transaction. Okay, so it'll be more expensive. Now you might be saying to yourself, well, hang on a second. Why, if B's got the better credit rating, why doesn't B just borrow both loans and save loads of money? Well, it could do, but that would put an awful lot of financial risk onto B. One company is very unlikely to want to use its credit rating to borrow loads of cash for another business, even if that made some savings. So it's normally deemed to be too high risk for B to take out the loans for both companies. Okay, so you'll normally make a gain on one of these and a loss on the other, but that's fine. So what we end up with is a net saving position. So we've saved 1% on the fixed rate loan, but we've lost 0.5% on the variable rate loan. So overall, we have a 0.5% saving across the two loans. Now, like I said, we're going to assume here, because it told us to, that each party gets an equal share. So we want each of them to be 0.25% better off than they would have been without the swap. Now, like I said, if it's going to be different to equal shares, it will have to tell you in a scenario, and you can just allocate it as it told you there. Now, once you've got to that stage and we've decided what the gain is going to be, and we know which business is borrowing which sort of loan, then you can finish off by constructing the swap. Now, there are lots of different ways of doing this, but the way that I always find the easiest and that tends to flow best for students is give yourself a couple of columns, one for each company. So I've got a column for A and a column for B. Leave yourself a few lines and then write down the outcome. Now, I know this is a bit weird, but what we're basically going to be doing is, it feels like we're cheating somehow, but we're going to start with the outcome and we're going to work back. Okay? So, we know from our calculations before that we want, after the swap, each party to be 0.25% better off than they would have been if the swap hadn't been there. So we can work out what we want their overall final interest rate to be. So if we look at A, for example, A wants to borrow fixed. It can borrow fixed by itself at 10%, but we said after the swap we want them to be 0.25% better off. So they want to end up paying 9.75%, okay, overall, because they wanted fixed, but they want to be 0.25% better off than they could do by themselves. B wanted to borrow variable. Now, it can borrow variable by itself at SONIA plus 0.5%, but we want it to be 0.25% better off, so we want it to end up at SONIA plus 0.25%. Okay, so 0.25% less interest charge than they would have got by themselves. So always kind of start off with the outcome. What's the position you want to get to? What we can then do is go back and construct the swap to make sure that each company gets to that point. So, the first line, going back up a few lines, would be, I need to think about, right, okay, what are they actually going to do? What are they going to borrow and pay? Now, we'd decided which company was going to take out which loan. So we said that A, even though it wanted fixed, had to borrow at the variable rate. So it's going to go to the bank and get a variable rate loan. Now, according to the scenario, it can take out a variable loan by itself at SONIA plus 1%. So it gets that out, and that's the interest it pays to the bank. B had to borrow fixed, even though it wants variable. When we set this swap up, we said B had to do the fixed borrowing. So B is going to borrow fixed at 9%, and that's what it's going to take out and pay to the bank. Now, the problem is that this is obviously not what the two companies want. So what we're going to do is we're going to make payments between companies A and B to get them from what they've actually borrowed and are paying to what the ideal outcome was that we'd calculated. Now, again, there's lots of different ways of doing this. I find the easiest thing is to kind of swap one thing at a time. It doesn't matter whether you start by swapping variable or fixed, but I would start off by making sure that one company, after the first payment, is paying everything, if you like. So let's swap fixed for this case. Okay, B is currently paying 9% fixed, and it doesn't want to pay fixed interest at all. So our first payment is going to be, well, A is going to pay 9% interest to B. So A is going to make a payment to B of 9% each year. Okay. Now, after this first transaction, you'll notice that net A is now paying everything, and B is paying nothing, because it's receiving the 9% from A that it's already paying. So it's quite handy doing this. Basically, get one of the companies as your first transfer to pay everything. So B is currently not paying anything at all. Now, we know from our calculations of our outcomes that B wants to end up paying SONIA plus 0.25%. Now, after the first transaction, after that first transfer payment between A and B, B isn't paying anything. So the last transfer, where we swap the variable rates, is essentially just fudging it to get it to work. So B is going to pay SONIA plus 0.25% to A. Okay, so if we look down at B, it's paying 9% to the bank, it's receiving 9% from A, so they cancel out. It's then paying A, SONIA plus 0.25%, and so it adds down to what we wanted it to add to, which is SONIA plus 0.25%. For A, it's paying SONIA plus 1%, then it's paying 9% on top of that to B, and then it's receiving SONIA plus 0.25% from B. Now, what you'll find is the SONIAs will cancel each other out because you're paying a SONIA and receiving a SONIA, and we end up with essentially a net plus base rate payment on the variable payments of kind of 0.75%. So SONIA plus 1% payment plus a 9% payment less a SONIA plus 0.25% receipt rather from B will give you the outcome you're after, which is 9.75% as a payment. So like I say, get one company to pay everything and then essentially fudge the final payment, the final transfer payment between the two companies to come to your ideal outcome. It's probably just worth saying with this one that actually any swaps are acceptable as long as you get the right outcome. You may see some questions in the scenario where it specifically says, you know, one of the transfers has to equal this. Again, in the exam, you're not going to get something like that. You'll be able to construct your own swap, and as long as it's reasonable, you'll be absolutely fine. You'll still get the marks for it as long as it comes to the correct preferred outcome. And that's it for a swap. So they're normally relatively nice and straightforward. You probably only get a few marks for it, but it's still definitely worth knowing. On top of that, don't forget you also need to be able to talk about potential drawbacks or risks of those, which we've covered in the lecture.